What will shape U.S. commercial real estate in 2026? Momentum is building, from reinvented workplaces and smarter logistics, to communities that thrive and retail that performs, and specialized infrastructure powering new demand. Up next, Newmark's sector researchers share what's driving each sector. Let's dive into the 2026 outlook and the strategies that matter now.
So I want to just walk over 5 things that are on our minds in terms of the economic outlook for this year. So one is that you've seen it in the Wall Street Journal, you've heard it a million times now, but just to restate, economic activity got a big boost last year from AI, both direct AI investment as well as wealth effects from the stock market and the optimism that attuned to that. It has to keep up the pace. Otherwise, it becomes a drag. Or to have it stick in your head, AI must be hot in 26 or we're in a fix. If we wanted AI to be an incremental growth impulse, we have to have even more. We're not necessarily bearish on this, but it underscores this idea that the economy is very heavily reliant on very specific determinants of growth. Underneath the hood of that, we see a lot of industries that are not in expansion. And so we need more broad-based expansion in order to feel much more confident about 26's growth outlook. This relates to the labor market. Point number 2. 80-90% of the jobs that were added last year were all in the healthcare sector. And we love healthcare. Healthcare is a great sector, but it means that the US labor market was a one-trick pony. And so if there's even a slight deceleration there that is not picked up by these other sectors, then it's going to be a much more troublesome labor market, which will put pressure on the Fed and can also undermine demand. Third, inflation. Recent statistics, headline statistics, have pointed in a positive direction towards disinflation, but there's a lot of consternation about the data quality underlying them. Lots of imputed prices, missing observations from multiple months. It's going to be a couple more months until the fog of the shutdown gives us more clarity on what the underlying inflation situation is. More positively, consumer spending appears to have reaccelerated in late summer into the fall with some good holiday spending numbers. Brandon, of course, will know way more about that than I do. The underpinnings of this are still low unemployment, wage growth, and the aforementioned stock market gains. The other wild card for stronger growth is productivity. The productivity data is always bad, very noisy, very difficult to extract signals from. Nonetheless, there are indications that GDP per hour worked are improving, and there's a lot of this, certainly embedded in the stock market is this theory that AI is going to lead to a sustained productivity miracle over the next 5 to 10 years. I think that there's, you could certainly make a credible argument for that, but it'll take time to see it play out in the data. So let's move on to the next slide. We'll see how we translate this into our 2026 outlooks in terms of economic scenarios. So leading scenario at the top in the bold, inflation stubborn, low growth, or as I like to call it, decaf stagflation. We think that this is broadly descriptive of what we saw in the first half of last year. And we think that it's a reasonable base case. It's consistent with some continued AI boom, some price resetting, and we think that it would allow the Fed to cut at most 1 to 2 times. We think the 10-year Treasury yield would be stapled in its recent trading range, 4 to 5. Not a lot of movement in credit spreads expected. We give that 45% odds. Next down the line, inflation stubborn, growth moderate. That looks to be a better descriptive of, for example, Q3 of last year. That has inflation still running hot, but growth is also running a bit hot. If we get sustained fiscal this year, AI even accelerates, and we see a bit of a broadening in the industries that are doing well, this could very much happen. We give it 20% odds, and we think the Fed in that case would probably be done. No more cuts, and the Treasury could actually move up a bit. Next is the word we fear, recession. We give that 30% odds. We're broadly aligned with most surveys of economists with that probability rating. In that case, we think that there'd be enough of a hit to demand for consumer goods, that this would allow the Fed to go through a conventional cutting cycle. We would not immediately anticipate QE in this instance. And that would put a floor under the Treasury, which we think would fall to around 3%, maybe briefly pushing below 3. Spreads would widen in that instance, especially if we do not go into QE. And then finally, Goldilocks, 2 and 2, guided there by a stepwise function from the Fed, which could give us 2 to 4 cuts. We think that that is a very narrow, very golden path, and we only, at the current state and time, give that 5% odds. And then I think last slide for me before I hand it off to Jessica and Joe is just to show you a little bit of a snapshot of what the Bloomberg consensus consists of. This is a histogram of how many folks chose on the left for GDP growth, on the right CPI inflation for 26, and it's broadly consistent with our outlook, which is plus or minus 2% growth, and pretty much everybody thinks inflation is going to still run hot.